Federal Reserve's next move could decide where your money goes next. Stocks, gold, and even the US dollar are all waiting for one thing: the tone of the Fed's October meeting minutes. So the question is, will the Fed's message push markets higher or signal more trouble ahead? Today we're breaking down what investors should watch from the October FOMC minutes, what the Fed's likely next steps are, and how they could impact your portfolio. The Fed's October 8th release comes at a critical time. The US government shutdown has delayed key economic data, leaving investors with limited information about the true state of the economy. That makes the Fed's language more important than ever. These minutes will reveal how officials view inflation, employment, and growth, and whether they plan to continue cutting rates this year. Right now, the Fed faces a tough balancing act: a weakening job market and stubbornly high inflation. That combination has raised fears of stagflation, which means slow growth combined with persistent price pressure. Despite that challenge, our analysis suggests that the Fed's tone will likely lean dovish, meaning more support for the economy through lower rates and easier policy. If that happens, it could be a major tailwind for US stocks and gold, while putting pressure on the US dollar. Let's start with equities. A dovish Fed usually means cheaper borrowing costs, more liquidity, and stronger risk appetite. That's good news for stocks. Even though the labor market is softening and policy uncertainty under the Trump administration continues, accommodative monetary policy is expected to outweigh those negatives. If the Fed confirms a dovish bias, investors should watch two sectors closely: technology and real estate. In tech, the Magnificent Seven, Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, and Tesla could see renewed momentum. In real estate, companies like D.R. Horton, Lennar, and NVR may benefit from lower mortgage rates and improving liquidity conditions. Overall, a supportive Fed could help sustain the S&P 500's current uptrend, even if the economy continues to slow. Now let's talk about the flip side: the US dollar and gold. A softer Fed stance tends to weaken the dollar while lifting gold prices, and there are three reasons why. First, when the Fed cuts rates, non-dollar assets become more attractive. Investors shift into other currencies and commodities, pushing the dollar lower. Second, a dovish Fed can encourage global monetary easing as other central banks follow suit. Combined with concerns about US fiscal health and central bank independence, that adds even more pressure on the dollar. Third, stagflation risk makes gold more appealing. When inflation stays high but growth slows, gold's role as a hedge becomes even more valuable. With central banks worldwide still buying gold at record levels and safe haven demand rising, analysts see further upside for gold prices if the Fed confirms a dovish tone. So what exactly will the Fed's October minutes tell us? First, the job market will be front and center. The latest ADP report shows private sector employment fell by 32,000 jobs in September, signaling a steady loss of momentum. Combine that with upcoming federal workforce reductions following the government shutdown, and it's clear the labor market is cooling fast. Second, inflation remains well above the Fed's 2% target. Both CPI and the Fed's preferred PCE index have trended higher since April. That combination of weak labor data and stubborn inflation creates the classic policy dilemma. However, based on the September FOMC meeting, Fed officials still appear more concerned about recession risk than runaway inflation. That means we could see a dovish tilt, with the Fed signaling up to 2 more rate cuts of 25 basis points each before year-end. This would confirm the Fed's shift toward supporting growth, even if inflation has not yet fully cooled. For investors, the implications are clear. If the Fed signals a dovish stance, US equities and gold are likely to benefit, while the US dollar index could weaken further. Tech and real estate remain the top-performing sectors under easier monetary policy, while commodity and currency traders may look to add gold exposure or reduce dollar holdings. But this is also a moment for balance. A dovish Fed could spark short-term rallies, but persistent inflation and weaker jobs data might limit how far those gains go. Investors should stay flexible, using this environment to adjust risk exposure rather than chase speculative trades. In a world of limited data and political uncertainty, the Fed's October meeting minutes might be the clearest signal markets have. If officials emphasize concern over employment and maintain a dovish tone, that would likely confirm a softer monetary path ahead. The bottom line is this: A dovish Fed means potential strength for stocks and gold, and ongoing weakness for the US dollar. But investors should stay alert. The same conditions that drive short-term gains, such as slowing growth and high inflation, could also bring long-term volatility. Stay informed, stay nimble, and as always, keep your eyes on what the Fed does next. Thanks for watching, and if you found this analysis helpful, make sure to like, subscribe, and follow Trading Key for more insights on markets, policy, and investing strategy.